The Fed raised interest rates once again. Who in the world could have seen this coming? We're going to talk about this very well telegraphed interest rate hike in this video. Some surprises I think may happen in the future during the December meeting with the Federal Reserve. And if you're watching this video the second time, I'm actually going to use the slides on this one. I recorded this before without the slides. So if you're watching this for the second time on YouTube, you got the slides this time. Let's get into it. Welcome to House Rich, the first time homebuyer show where we help millennials figure out where do I get started in real estate and how to build generational wealth. So let's use some quotes from Jerome Powell, the big chairman himself. He says, we'll take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So why is he saying this? As we all know, interest rates have gone up like almost like a 45-degree angle this year. And so what he's saying is that, hey, I'm trying to do things to combat inflation involving raising the short-term cost to borrow money, the benchmark rate, but things are lagging, right? So if you think about it like this, like let's say in January, I'm like, hey, I'm under contract in January to buy a house. I'm not going to buy that house until actually February. So with people already in the process of buying a house, like there's already a 30-day lag. Then there's the people that are like set on, hey, like I'm buying a house no matter what, probably when rates are like in the 3 and 4s. And then so those folks are like, man, I don't know, rates have gone up pretty quick. I gotta kind of think about it. So there's a time for those people to get in and out the market, for those people to kind of see how home prices are doing. And so it takes a while for things to happen right in the actual market. But the other thing as well is that Mr. Powell and the folks can control is a lot of these big companies are hiding behind inflation when they're just jacking up their prices, right? So it's normal for a company to raise their prices to move to coincide with inflation, right? It's like, hey, it used to cost me, I don't know what lumber costs, but it used to cost me $5 for a piece of lumber, right? And then it cost me $7 for a piece of lumber. And so of course, I'm going to raise my prices at least $2 to keep up with my margin. But a lot of these companies are like, hey, I'm going to raise prices $10, $15, and just say, hey, it's inflation. And so that's what a lot of companies are doing. Like profits are at like record highs for a lot of these companies. Like think about gas, right? A lot of people like to blame the economy, blame the president on gas. These companies, these oil companies, are just making money over top of money as far as gas is going, like raking in record highs because folks are like, oh, Putin did this, inflation did that, but they're making money hand over fist, right? So that's kind of what Big Powell is talking about when you're talking about, hey, we need time for things to take effect. And so let's take a look at this chart right here. We just get a snapshot of what the Federal Reserve has done with as far as rates. So this is the fourth time they've raised interest rates this year. You can kind of see where these spikes are is where they raise interest rates, or where they raise the cost to borrow money, which impacts the interest rates as well. So the Federal Reserve moves short-term lending. So we're talking about like credit card APRs and stuff like that. But it sort of coincides with mortgage lending as well, because it kind of like trickles down to that. Because what happens is banks, they sell your debt. Like with mortgages, as mortgage-backed securities, they package those up and sell it off, and then they sell other debt as well. And so in order to keep the debt with mortgage-backed securities competitive with what's on the market, like they raise the interest rates to coincide with that. So if you look at this chart right here, right? Let me get my highlighter up. And so you kind of see the cost to borrow money was below 0.5%, back in 2020, 2021. And so if you look at the cost to borrow money now, like the Federal Reserve this is a old chart, but they've raised their cost to borrow money into the 3.75 to 4.00 threshold there. And so if you think about it, back then, so if the cost of borrow money was 0.25%, your interest rate is going to be like 3.5%. Now the cost of borrow money is like 3.75%. And so now your interest rates are like 6.75%. See how that kind of works out there? And so as far as this rate, like this was well telegraphed. The Federal Reserve actually kind of pretty much announced this in September during their last meeting, that they would raise the cost of borrow money 75 basis points on November 2nd, as well as 50 basis points in December, during the December meeting. But we're going to get into some news that may impact that projection for the December meeting. But so you probably saw interest rates jumped up to like 7% last week. And that's because every single lender in the world knew this rate hike was coming. Even amateurs, so average people like me knew this interest rate hike was coming. You would have known it was coming as well if you followed my information. So I would say like the video, subscribe so you can get updates on what's going on in the housing market. Like, because I actually like read the articles, not just the headlines, like a lot of folks on this internet. And so when folks talk about, hey, this is the highest it's cost of our money since 2008. Yeah, it is. So if you look back what's happening in like 2008, like we were like shy of 6% as far as the cost of our money. Right now we're just under 4%. So yeah, and so you're thinking, hey, is this 2008 all over again? It's not. There are a lot of factors in 2008 that are not present today. As far as lending habits are a lot more established since 2008. There are adjustable rate mortgages aren't as much as they were in 2008, and the inventory isn't what it was in 2008. So those are some factors in 2008 that have nothing to do with what's going on now. You can check like previous videos I put out, such as why this ain't 2008, to get a little bit more context on that. All right, so as he said right here, the committee anticipates that the ongoing increase in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to over 2%, to 2% over time. Excuse me. So once again, the whole mandate from the Federal Reserve is to lower inflation, home prices, and everything be damned, right? They're trying to get it from 8% to 2% because rates were artificially low during COVID due to the Fed. And so now for every action, there's an equal and opposite reaction. So let's also get into the new policy change that was kind of hinted in what the Federal Reserve talked about. So I was actually reading this article in CNBC that pointed out that the Federal Reserve, and I assume they may know this because they move in rooms that I don't move in, because the Federal Reserve didn't come out and say this, but they implied that the Federal Reserve may actually try to lower the benchmark rate or the cost of our money in December 50 basis points or keep it the same. And the logic behind that kind of made sense because like there's a lot of shock in the economy because rates have gone up so quickly. And so if they like actually lower the cost of our money 50 basis points, but then still continue to raise it in 2023, right? But at a smaller clip. Instead of like these 75, 50 basis point hikes, like these historic hikes, they may do like a quarter or like a dime or something like that, like 15%, 10%, 25% to raise it slower in 2023. Because remember, everything lags behind. So it's kind of hard to see if things are actually taking effect, especially when they're doing things so quickly and there's so many factors in the economy. So if they slowly lower interest rates more, they may give them a better control over what's going on with the economy. So that was an interesting perspective I saw in the article from CNBC, even though the Federal Reserve didn't come out and say that. And Jerome Powell kind of said that, hey, we're not saying that we're going to do this. We're not saying we're not going to do this, but we'll see in the next December meeting. So let's get into why it probably is not like 2008. All right. So let's take a look at this chart right here. So we're looking at mortgage originations by credit score from back in the 03 all the way up until like 2022. And you kind of see, just look real quick, look at the 760 crowd that owns property versus now versus back then in the 2000s. And even more, look at the sub 620 crowd back then versus now. And it's almost like, I don't know, like maybe 4 or 5 or 6 to 1. And so that kind of goes to show that the lending habits are a lot more stricter now than they were in the early 2000s, right? Let's go look at the next chart. So once again, adjustable rate mortgages, they're a lot less now than they were back then. So if you don't know what an adjustable rate mortgage is or an ARM, it basically is you have a low rate for a short time frame, and then once the rate adjusts somewhere between 1, 3, 4, 5, 6, 7 years from now, your rate goes basically to what the market is. So like if you locked in like a 4% like in 2003, right? And your rate adjusted to whatever the market was in 2008, their rate may have gone from a 4 to like a 6.5%. And so your payment could have jumped from like a comfortable $1,000 to like maybe an uncomfortable $1,500. And so that's what jammed up a lot of people, was that they just assumed they could keep refinancing and refinancing and refinancing those arms, which goes back to the reckless lending habits. And once again, if we just look at the percentage of people that have a mortgage under what the rates are right now, there's almost everyone has a mortgage under what the rates are right now because they're high relative to what's been going on in the last 2 years. So once again, it's not like if anybody got a mortgage in 2020, 2021, their rate goes up. It's a fixed rate. Like all those folks locked in rates. If you go back and look at the previous chart of ARMs then versus now, like why would anybody get an ARM when rates are so low now versus then, right? So yeah, that's kind of a snapshot of what's going on now versus went on in 2008. If you guys got any more questions, let me know, and I'll say join First Time Homebuyer School. It's a community of folks that are they would like to communicate with what's going on in the market, and I let those folks actually pick topics for the lessons that go down. So that's all I got. Listen to the podcast too as well. The link will be below. And buy land. Rumor has it they're not making any more of it. Thank you for listening to the show. If you want to connect with other listeners and also dive deeper into topics, as well as attend live trainings every Tuesday at 8 p.m., click the link down below and join the First Time Homebuyer School. See you inside.